welcome to today's deep dive. We are really thrilled to have you with us.
Absolutely. Thanks for having me.
If you've been paying any attention to the financial world lately, or honestly, even if you've just been sitting at a coffee shop or attending a family gathering, you've probably noticed a massive shift in what people are talking about.
Oh, yeah, it's everywhere.
Today, we are looking at a fascinating cultural and financial phenomenon, which is Taiwan's massive ETF fever.
The sheer scale of this trend is, it's truly remarkable. We are seeing a complete transformation in how everyday people interact with the stock market.
Right.
It's shifting from viewing the market as this intimidating space reserved for professionals to something that's discussed casually over dinner.
And to guide our exploration today, we are pulling from a really fantastic educational article. This material breaks down the investing trend, explains the primary drivers behind the boom, and crucially provides the essential English vocabulary used to discuss it globally.
Which is so important right now.
It is. Our mission today is to decode exactly what an ETF is, explore why everyone in Taiwan, from college students to retirees, just cannot stop talking about them, and arm you with the exact English vocabulary you need to confidently join this conversation.
It's a great mission.
Okay, let's unpack this. What exactly is an ETF?
Well, let's start with the acronym itself. ETF stands for Exchange Traded Fund, and the core traits are actually quite straightforward.
Yep.
First, it is a type of investment fund that holds a basket of stocks or bonds. Second, it tracks a specific index. And third, it can be traded on the stock market just like a regular individual stock.
I always hear that basket analogy used, but how does that actually play out for someone who is completely new to putting their money in the market? I mean, why not just buy the best company you can find?
Think about the traditional way people used to invest. They would try to find that one golden company, betting all their money on a single stock and hoping it outperforms everything else.
Which is incredibly risky.
Extremely risky. The basket approach changes the game entirely. Instead of betting on one single apple, hoping it's the crispest one in the store, you are buying a pre-packaged, assorted fruit basket.
So you get a little bit of everything all at once.
Exactly. By doing this with companies, your investment becomes diversified.
Hmm.
It is highly beginner-friendly because you are essentially spreading out your risk. If one company in the basket has a bad day,
You have dozens of others that might be having a great day to balance it out.
precisely.
That explains the appeal, but the numbers we are looking at go way beyond casual interest. The research mentions that some newly launched ETFs are attracting billions of NT dollars within merely days of becoming available. Billions.
It's staggering.
That kind of capital moving that quickly points to something much bigger than just a new financial product.
What's fascinating here is how this has completely crossed demographic lines. We aren't just looking at the traditional older investor class making these moves anymore. Many young investors are opening up brokerage accounts before they even turn 30 years old. This points to a massive cultural shift in who feels empowered to participate in the markets.
We're seeing investing conversations moving out of stuffy financial institutions and straight to the family dinner table.
People are discussing their investment strategies right alongside their upcoming travel and holiday plans.
Imagine passing the potatoes at dinner and casually asking your aunt about her asset allocation.
Right.
But that is the new reality. People are constantly asking each other which funds they are buying or if they got their payout this month. It has become a completely normalized part of everyday social interaction.
It really has.
But to understand why it has become so normalized, we have to look at what exactly people are putting their money into. The research identifies two main drivers of this boom.
Yep.
Let's start with the heavyweights, specifically the broad market approach.
You really cannot talk about Taiwan's ETF fever without talking about the Yuanta Taiwan Top 50 ETF.
And in conversation, everyone just calls it 0050.
Exactly, 0050. This specific fund tracks the 50 largest companies in Taiwan. So when you buy into 0050, you aren't guessing which specific tech firm or which individual bank will dominate the next quarter.
You are essentially capturing the overall market performance of Taiwan's major corporate players.
Right.
But doesn't that take the excitement out of it? The old school stock pickers loved the thrill of finding that hidden gem before anyone else did.
That lack of excitement is actually the main selling point. It is simple and it is transparent. You always know exactly what you are holding, the 50 biggest companies.
It takes the guesswork out of the equation.
Exactly, making it highly suitable for steady long-term investing. The investors holding this are generally in it for steady, overarching market growth. They don't want the thrill of a casino. They want the reliability of an economic engine.
Here's where it gets really interesting, because while broad market growth is great, there is a second massive driver fueling this fever. It is not just about the slow, steady climb of the top 50 companies.
No, it's not.
The other half of this phenomenon is all about high dividend ETFs.
The income approach. High dividend ETFs focus specifically on companies that regularly pay out a portion of their profits to shareholders.
And the psychology behind this is incredibly powerful.
Oh, absolutely. When you invest in these funds, you receive cash payouts, often on a monthly or quarterly basis.
Let me play devil's advocate for a second here. Isn't getting a dividend just moving money from one pocket to another? If the company pays you cash, the overall value of the fund technically drops by that same amount. Aren't people just tricking themselves into feeling richer?
Mathematically, there is a strong argument for that, but human beings don't always operate on pure spreadsheet math.
Fair point.
For a lot of people, receiving that notification that cash just dropped into their account creates a profound feeling of generating passive income. It provides extra, tangible cash flow, which in turn creates a deep sense of financial stability.
With broad market growth, your portfolio number goes up on a screen. It's abstract.
Yes, exactly. But with high dividend ETFs, actual cash is arriving in your bank account regularly, which you can use to buy groceries or pay a bill.
I see the appeal. It feels like a second paycheck. It's an immediate, tangible reward for the decision to invest.
And that tangible reward is why they're so fiercely popular. But we shouldn't view this as a battle between the two strategies. Broad index funds like 0050 and high dividend funds are both major drivers of the boom.
They serve different psychological and financial needs, but they are both fueling the overall fire.
Yes.
There is a great sample dialogue in the material that illustrates this perfectly. One person asks 0050 or high dividend, and the other person simply replies both. I want growth and income.
It encapsulates the modern investor's mindset perfectly. They aren't choosing one over the other. They are building a portfolio that captures the long-term appreciation of the broader market while also securing that comforting, regular cash flow.
Let's shift gears slightly, because how they are building those portfolios brings us to another critical aspect of this fever.
Right. It is not just about what they are buying, but the specific mechanics of how they are buying it. There is a massive cultural movement toward dollar cost averaging.
I keep seeing the acronym DCA everywhere online. What exactly are these investors doing differently than the previous generation?
Dollar cost averaging means investing a fixed amount of money every single month on a regular automated schedule.
So you ignore the daily financial news.
Completely. You don't worry if the market is hitting an all-time high or an all-time low. You just invest that same set amount consistently. Instead of trying to time the market, which is notoriously difficult even for Wall Street professionals, these investors focus purely on consistency.
So if I have 5,000 NT dollars, I put it in on the first of the month, every month, no matter what the headlines say.
That's the mechanism. The mindset driving this is slow and steady wins the race.
I like that.
By investing a fixed amount regularly, the math works in your favor without you having to think about it. You automatically buy more shares when prices are low and fewer shares when prices are high. This averages out your cost over time.
More importantly, it fundamentally changes the emotional experience of investing.
It really does. It feels safer and is far less stressful for beginners because it removes the anxiety of trying to pick the perfect moment to click the buy button.
It totally takes the emotion out of the actual transaction. You set it, forget it, and let time do the heavy lifting.
Exactly.
But even with automated systems, taking that initial leap requires confidence. Where are all these young, everyday people getting the confidence to start pouring their savings into the market in the first place?
The community effect here is undeniable. We have to look directly at the role of social media and investment communities. Investment YouTubers, finance influencers, and online forums have taken what used to be very dense, intimidating financial jargon and made it highly accessible.
It really feels like social media has gamified and popularized financial literacy. The research points out that dividend announcements now actively trend on social platforms.
They do. People are logging on and seeing exactly how much certain funds are paying out, and it creates this massive buzz, almost like sports fans discussing player stats.
It is completely common to hear someone say they bought something because a friend recommended it or they saw it trending online.
If we connect this to the bigger picture, This trend isn't just about people mindlessly chasing returns because of a catchy YouTube video. It reflects a much deeper, growing awareness of long-term planning.
People are using these modern platforms to educate themselves, compare notes, and take control of their financial futures.
They are learning to invest, and they are doing it together as a massive online community.
It is inspiring to see so many people taking charge of their finances, especially younger generations who might have felt locked out of traditional wealth-building avenues.
Absolutely.
But as with any massive financial trend, we have to ground the conversation. It cannot all just be guaranteed passive income and endless growth.
This raises an important question. What happens when things don't go perfectly? Because they won't always go perfectly. Every investor needs a reality check, and the material outlines several stark realities that tend to get ignored when the market is booming. First and foremost, markets fluctuate. Prices go down just as easily as they go up.
And it is not just the stock prices that drop, right? Those monthly cash payouts that everyone loves so much aren't guaranteed either.
Far from it, dividends can change. A company or a fund manager can decide to lower the payout, or even suspend it entirely depending on the macroeconomic conditions.
That extra cash flow is not a guaranteed salary, even if it feels like one during a bull market.
Exactly.
Which means if the market takes a dive, not only is your overall portfolio value dropping on your screen, but the actual cash hitting your bank account might shrink too. I can see how that would cause a panic.
That panic is the third major risk mentioned. Short-term volatility easily causes investors to make emotional decisions. When you see your portfolio value drop by 20%, the anxiety sets in and people abandon their slow and steady dollar cost averaging strategy right when they shouldn't, when prices are actually cheaper.
Right. The ultimate golden rule of investing, a phrase every single investor must internalize, is past performance does not guarantee future results.
Exactly. Just because a fund had a great year last year does not mean it will have a great year this year.
You have to go into this with your eyes wide open. Now, speaking of being fully prepared, a huge part of understanding this entire phenomenon is knowing the language.
Yes.
I know you listeners already understand how a portfolio functions mathematically, but if you were trying to read international financial news, watch English-speaking investment YouTubers, or debate these strategies online, nailing the exact English phrasing is crucial.
The final section of our research provides exactly that, the crucial English vocabulary terms used to discuss this ETF fever globally. We are going to go through these terms using the exact English definitions and example sentences provided in the material.
Let's treat this like a survival guide for your next dinner party or coffee shop debate. If I'm sitting down with someone and I want to explain the foundation of this entire trend in English, what's the first term I need to drop?
You start with ETF. The English definition is a fund tracking and index trading like a stock. For context, you could say something like, many investors in Taiwan prefer ETFs for diversification.
Okay, so I've bought my fund. Now I want to brag about the cash I'm getting from it every month. What's the specific term for that payout?
That brings us to dividend. The definition is a payment from a company fund to investors. In a conversation, you might point out someone's strategy by saying, he invests in ETFs that pay regular dividends.
Got it. Now, what if someone asks me why I'm using the basket approach instead of just buying one tech stock? I need to sound like I'm mitigating my risk.
The term you want there is diversification. It is defined as spreading investments to reduce risk. You would explain your strategy by stating diversification helps lower overall risk.
Makes sense. Now let's talk about the strategy of putting in 5,000 NT dollars on the first of every month no matter what.
That is dollar cost averaging. The definition is investing a fixed amount regularly. If you were describing a friend's consistent habits, you'd say, she uses dollar cost averaging to invest every month.
But what if the market gets bumpy? What's the word I use when the prices are swinging wildly and everyone is panicking?
That is volatility, it means. How much prices move up and down. The example provided highlights the emotional aspect we discussed earlier. High volatility can make investors nervous.
Okay, let's say I own 0050 for growth, and I also own a high dividend fund for income. What is the English term for my entire collection of holdings?
That is your portfolio, defined simply as a collection of investments owned by someone. You could describe someone's holdings by saying, his portfolio includes both 00050 and dividend ETFs.
Beautiful. Now, what about the ultimate dream? The reason people love those dividends so much, making money while they sleep.
The phrase for that is passive income. The definition is income earned without active work. It perfectly describes the goal of many participants in this trend. Many people hope ETFs can generate passive income.
And lastly, what if I don't care about the monthly cash payouts? What if I just want the total value of my holdings to grow massively over the next 20 years?
Then your focus is on capital appreciation. The exact definition is an increase in investment value. As an example, long-term investors often look for capital appreciation.
Mastering those 8 specific terms and their definitions really unlocks your ability to engage with this topic on a global scale.
It gives you the linguistic tools to navigate the international financial discourse without missing a beat.
By combining the financial mechanics of broad market funds and high dividend funds with the cultural elements of dollar cost averaging and social media, we get a truly complete picture of why this phenomenon is reshaping personal finance.
It undeniably has woven itself into the everyday fabric of life.
So what does this all mean? Ultimately, it means that investing is no longer a niche hobby hidden away behind closed doors or reserved for the ultra-wealthy. We have explored how broad market funds offer long-term capital appreciation by tracking the top companies, while high dividend funds provide that satisfying, tangible passive income.
Yes.
We break down the calming, automated psychology of dollar cost averaging and the undeniable gamified influence of online communities. Whether you are looking for market growth, chasing dividend income, or just trying to understand what your friends are debating at the dinner table, mastering these concepts and this specific English vocabulary is the key to joining the everyday conversation in Taiwan right now.
As we wrap up our analysis of this fever, I want to leave you with a final thought to mull over. With so many young, new investors relying heavily on social media influencers and the sheer excitement of online forums to build their ETF portfolios, how will this wisdom of the internet crowd hold up emotionally and financially when this new generation faces its first major, prolonged market downturn?
That's a serious question.
It is one thing to dollar cost average when dividend announcements are trending and the market is generally moving up, but it will be entirely different to see if that slow and steady mindset survives when the hype completely fades and true volatility sets in.
That is a brilliant and provocative question to ponder as we watch this financial journey unfold. Thank you for joining us for this deep dive. Keep learning, keep questioning, and we will catch you next time.